On August 5th, Nisen Arsith, Japan's stock market suffered its worst single day since Thin Chu 5 and the Nikkei fell over 16 points, more than 2% in a single session. The BIX volatility index spiked above Luxembourg's $670 billion evaporated from global markets before lunch.
Nothing had happened in Tokyo. No corporate scandal. No natural disaster. No earnings miss. What happened was this: the Bank of Japan had quietly raised its interest rate by 0.25%.
That's all it took. Now Japan
To understand why a Japanese interest rate move can crash markets in New York, you need to understand the most important financial trade of the last 2 decades, the yen carry trade.
The mechanics are simple. You borrow money in Japan at near zero interest rates, then you take that money and invest it somewhere that pays more. US Treasuries, emerging market bonds, tech stocks, almost anything. You pocket the difference. As long as the yen stays cheap and Japan keeps rates low, it's essentially free money.
For 30 years, that's exactly what happened. Japan's benchmark interest rate sat near zero, or below zero, from the late 1990s all the way through Nisen Nirsen Tain at its lowest point. The BOJ was charging banks to deposit money, negative Lit Tain each %. The Japanese central bank was literally paying people to borrow.
The result was a $100 billion to $1 trillion ecosystem of yen-funded positions circling the globe. Hedge funds in London, pension funds in Singapore, trading desks in New York. All of them, in one form or another, borrowing in yen and deploying elsewhere. The Bank for International Settlements, which tracks global financial flows, estimates the total yen-dollar swap market at around $3 trillion. Though much of that includes legitimate commercial hedging, the purely speculative carry trade is likely in the hundreds of billions. Nobody knows exactly. And that uncertainty, as we'll see, is precisely the problem.
Then, in March, the Bank of Japan did something it hadn't done in 17 years. It raised interest rates.
Governor Kazuo Ada had taken over the BOJ in April Nisan, with one overriding mission: end the era of emergency monetary policy. Carefully, without triggering a crisis. Japan had finally achieved what decades of economists said was impossible. Wages were rising, prices were rising. The deflationary mindset that had paralyzed Japan since the 1990s bubble collapse was finally cracking.
Japan's spring wage negotiations, what locals call shunto, delivered increases above 5% for 2 consecutive years. Real wages, after years of stagnation, were moving higher. In this environment, 0% interest rates weren't just unnecessary, they were potentially dangerous, fueling asset bubbles in Tokyo real estate and pushing the yen to levels that made imports punishingly expensive.
Here's what's crucial to understand about August 5th. Nisen C-Dien, the July Nisen C rate hike. From 0.1% to 0.25%. wasn't a surprise in the sense of being unannounced. The BOJ telegraphed it. Markets thought they were ready.
They weren't. When the yen started appreciating after the hike, because higher rates make a currency more attractive, carry traders began unwinding their positions. Borrow yen, buy assets. When the yen gets expensive, you need to sell the assets, buy back yen, repay the loan. One trader selling forces the yen higher. A higher yen forces the next trader to sell, and so on.
In the weeks around August 5th, the yen strengthened from roughly back Lucius to back source Daru against the dollar, and %% appreciation in a matter of weeks. JPMorgan estimated that up to 90% of yen carry trade positions were closed in the aftermath. The Nikkei's worst day since Black Monday, BUI at Luxembourg, levels associated with full-blown financial crises. Global stocks down hundreds of billions in hours.
And then, because this is finance, the trade was rebuilt by early Luke, according to reporting from Inves and BCA Research. Yen carry positions had largely returned to pre-crash levels. The logic was seductive. The BOJ had paused. Rates were still far lower in Japan than anywhere else. The spread was still there. Why leave money on the table?
This brings us to April 28th. Nourish Lotian, at its most recent policy meeting. The Bank of Japan voted to hold rates at 0.5%. But here's what the headlines buried: 3 of the 9 board members dissented. Board members Takata, Tamura, and Nakagawa all voted to raise rates immediately to each percent. According to Trading Key, this was described as the biggest internal divide on the board in a decade.
Governor Ueda held firm, citing geopolitical uncertainty from the Middle East, but his overall tone was characterized as hawkish. The BOJ simultaneously raised its core inflation forecast for fiscal year 2026 to 9.8%, up from 10%.
Japan's economy is no longer in emergency condition. Real wages rose each % year-over-year in March, the third consecutive positive month. The first three-peat since 10 February had seen 9% real wage growth, the strongest in 5 years. Shunto, delivered base pay increases of 3.1%, above 5% in total compensation, for the third consecutive year.
The BOJ's own precondition for rate normalization, a sustainable wage price cycle, has arrived, which is why, heading into the next meeting on June 15th and 16th, market pricing puts the probability of a hike to 1% at 90%. Reuters polling shows 60% of economists expect it by end of June. A rate of each % in Japan would be the highest since the 1990s bubble era.
And yet the carry trade is back. The JGB market, Japan's government bond market, is already sensing what's coming. The 10-year Japanese government bond yield has surpassed 2.5%, its highest level since 1997. The 30-year yield is above 3.5%. Earlier this year, the 40-year yield briefly touched 1%. For context, Japan's government carries debt equal to roughly 2% of its GDP, the highest among developed nations. Every basis point rise in yield costs tens of billions in additional interest payments.
Here's the Japan factor insight that most Western analysis misses. Japan's monetary normalization is not a problem. It's a success. After 30 years of trying and failing to generate inflation and genuine wage growth, Japan has done it. The virtuous cycle: wages rise, prices rise moderately, the central bank normalizes, repeat, is finally running. Japan is healing.
The problem is that the global financial system built a $100 billion to $8 trillion infrastructure on top of Japanese near-zero rates. Hedge funds, institutional investors, and trading desks have been using cheap yen as the foundation of countless other bets for 2 decades. Every quarter point BOJ hike incrementally raises the cost of that foundation.
August, Mensi 4 showed what happens when just several basis points catches markets off guard. Now we're heading toward Bay basis points above the floor from Lingdian Seawall % toward each %, with further hikes plausible if Japan's wage price cycle holds.
The June 16th BOJ meeting is the one to watch. If the 3 dissenters get their way and the board votes for each %, yen-funded positions across the globe will face another stress test. Whether that triggers another crash depends on how much has already been unwound. And as we've established, nobody knows for certain how large the trade is.
Japan, for the first time in a generation, is not the world's emergency lender. It's a normal economy with normal rates, slowly, carefully returning to what interest rates are supposed to do. The question isn't whether the BOJ will keep hiking. The wage data, the inflation data, and 3 dissenting board members all point the same direction.
The question is whether the rest of the world was paying attention to what happened on August 5th. 9th and C3rd, based on the trading data. Apparently not. Word count. C thing fusajanai words. Estimated duration. 9 1 lim minutes. Format news flash.